It's a pleasure to be here. Thank you, George. And it is indeed an honor to be associated with anything having to do with Prem Watson, who is known in the pages of Grant's Interest Rate Observer as, Warren Buffett, rather, is known in the pages of Grant as the Prem Watson of America. So, ladies and gentlemen, I am delighted to be here, and I want to tell you about sometimes having a bad decade. Once I was involved in the founding of a deep value investing partnership. The late Alex Porter and I got together and we decided that we would harvest the compelling values on offer in Japan. The year was 1997, 98. And my associate Ken Shirley volunteered to go to this netherworld of Japan and to scout companies. And together, the three of us would get very rich indeed. So we did this. Well, we went there and we scouted companies. Ken identified a dozen or 15 or so Japanese companies that were selling, many of them below their net current assets, which is to say that the business value of the stocks was as it were, free. We started this and we persisted. And in, I don't know, in the mid 1990s or so, we went to see, well, mid-aughts, we went to see one of our early substantial investors. What we had to tell them was that profitable, growing, well-financed, dividend-paying, micro-cap Japanese companies were still trading at less than the value of their net current assets. They were Ben Graham's famous or sometimes notorious net nets. So the investor, an aristocratic Frenchman who sat at the head of a leading New York investment bank, heard us out. Wreaths of cigar smoke issuing from his desk, and he offered a Gallic shrug. And he consoled us, his visitors, with these words. He said, sometimes, he said, you have a bad decade. I'm not sure how consoled we were, but I do love that phrase. Sometimes you have a bad decade. And as George has shown us, yes, sometimes one does. Markets tend to move in long cycles, many of them do. Bond markets notoriously or famously take their own sweet time. There was a great bond bear market in 1946 to 1981, and the succeeding bull market beginning in 1981, the fall of 81, 40 years ago, still in progress. So one must be patient, and we value investors are nothing if not patient. So the search for public securities priced at a discount to their estimated intrinsic value is not always easy or successful. In the past 10 years or more, the trouble is it has almost come to seem futile. The reasons behind the lowest state of value investing is my first order of business this morning. Ideas on where to find a margin of safety in an overvalued market is item number 2, and today's unique monetary, fiscal, and interest rate backdrop, which will feature throughout these remarks, is topic number 3. Now, to prepare for this COVID delayed event, I've given myself the pleasure of returning to the second 1940 edition of Ben Graham's magnificent security analysis. The book to me seems fresher, wiser, and timelier than ever. On this rereading, I saw how familiar the plaints of today's value investors would seem to Graham if he could return to Earth to hear them. Like us, the master lived through an epic bubble. Indeed, he himself mistakenly bought into it, on margin, no less. And like the chagrin holders of cheap Japanese equities in the 20th century, Graham lived through long periods of seemingly inexplicable undervaluation in the wake of the bust. The efficient market hypothesis was still a gleam in the eye of unborn professors in 1940. But Graham seemed to anticipate the errors of their ways. Not that the market was innately inefficient either. Its inveterate tendency was rather to exaggerate, said Graham, in both directions, up and down. In his day, too, ideas, vogues, manias were as cyclical as were prices. And then, as now, the value approach was honored more in the breach than in the observance. And here's Graham writing with his co-author, David Dodd, about the world he lived in. This was his zeitgeist. Quote, the partialities of the market have tended to confound the conservative viewpoint. And conversely, many issues appearing cheap under analysis have given a disappointing performance. Close quote. Now, Graham was a classical scholar and magnificently literate man, and his writing style, I think, is sonorous and very, very pleasing. But this phrase, the partialities of the market have tended to confound the conservative viewpoint, almost makes me burst out laughing now. My goodness, if there was ever a slightly overwritten understatement, it is that. So Graham felt it, we feel it. What a time Graham and his generation had of it. World War I gave way to the Spanish flu pandemic, and the pandemic to the 1920-21 depression, a blighted period made brighter slightly by the founding of Treaty Brown, more than slightly. And while the 1920s roared, the 1930s sobbed. Yet Graham somehow found the strength to compose the first edition of his magnum opus as his own finances were collapsing in a heap. You recall that top to bottom, Graham's partnership was down 70%, 70%. His resilience was as remarkable, or more so, more remarkable perhaps than even his intellect. It is an astounding testament to his tenacity of spirit and determination that he completed this difficult work at this time of personal defeat. In fact, I am going to veer slightly off script, and I'm going to read you a passage from Graham's autobiography. It's much less known, much less read than it ought to be. It's called Benjamin Graham, The Memoirs of the Dean of Wall Street. A somewhat grandiose title. I'm sure it was not his. But I'm going to read you this paragraph of Graham reminiscing about what had happened to him. So as I say, he was down 70%. Personally, he was down 80. And here is Graham, quote, it's true that I wasn't ruined and that at the low, I still had means which would have seemed quite large to me only 10 years before, but wealth and poverty are relative terms. A poor man in New York would be a rich man in Calcutta, and practically everyone who has lost 4/5 of his wealth considers he has suffered a disaster, no matter how much he has left. The chief burden on my mind was not so much the actual shrinkage of my fortune as the lengthy attrition, the repeated disappointments after the tide had seemed to turn, the ultimate uncertainty about whether the depression and the losses would ever come to an end. And to this, the realization that I was responsible for the fortunes of many relatives and friends, that they were as apprehensive and distraught as I myself. And one may understand better the feeling of defeat and near despair that almost overmastered me towards the end. So yes, we have had a bad decade, but ladies and gentlemen, others have suffered worse. So risk aversion is, of course, at the heart of the value approach. It's inherent in the disciplined pursuit of bargains, that phrase being Seth Klarman being one, of course, today's value greats, who called his 1992 investing handbook a margin of safety. So Graham's audience probably didn't need much persuading on this point of risk. Germany had invaded Poland in 1939, so World War II was underway as the second edition of Security Analysis debuted. And here is Graham dryly remarking on the prevalence of risk in that particular year. Quote, the combination of a record high level for bonds with a history of 2 catastrophic price collapses in the preceding 20 years and a major world war in progress, is not one to justify airy confidence in the future. Well, today, we associate ultra low interest rates with white hot speculation and, of course, a more than airy confidence in the future. It would be 80 years before the Federal Reserve first intervened to set a floor under corporate bond prices. This, of course, happening in the 2020 pandemic spring. In 1940, interest rates had been falling for almost 20 years. In 2021, they have been falling for almost 40. Long experience, muscle memory, a worldwide yield famine, and official pledges of continued, perhaps indefinite, monetary accommodation have taught today's fixed income portfolio managers to buy first and ask questions, if at all, later. Not many passages in security analysis are as dated as the one announcing 3 basic precepts of bond investing. These things are in italics, these precepts. And Graham wrote the italics, and they seem to convey, as I look at them, they seem to convey kind of ecclesial authority of clay tablets. You read them and you think that maybe Moses had drafted them rather than Benjamin Graham. And here they are. Here are the big 3. Safety is measured not by specific lien or other contractual rights, but by the ability of the issuer to meet all its obligations. 2, this ability should be monitored under conditions of depression rather than prosperity. 3, deficient safety cannot be compensated by an abnormally high coupon rate. I can't help but wonder how Graham might have adapted his message to the 21st century style of central banking. In the absence of depressions, is a foreshortened recession test now the applicable one? In the absence of credit crises, the Fed having presumably seen to that as well, what's the true nature of credit risk? Assuming the existence of a Powell put, how to calibrate tomorrow's equity risk? Anyway, Graham took his world as it was, and he marveled at the net nets that had begun to pop up in 1929. Yeah, at the top, and were thick on the ground at points during the 1930s. Security analysis, as you may recall, devoted an entire chapter to the fundamentally illogical phenomenon of companies that changed hands in the public market at less than their private liquidation value. So Graham, among other things, as you may recall, was a playwright, a poet, and also a financial hack. He was a financial journalist from time to time. He wrote a piece for Forbes, in I think 1933. Are American corporations more valuable dead than alive? Dead than alive was the headline, or something very close to it. So these nets are, they're kind of a concave bubble, aren't they? The cyclical mirror image of boom time dazzlement. For the crop of absurdly undervalued American stocks in the 1930s, Graham blamed the 1920s doctrine, quote, which transferred all the tests of value to the income account and completely ignored the balance sheet picture. In consequence, Graham went on, a company without earnings was regarded as having very little real value, and it was likely to sell in the market the merest fraction of its realizable resources. Most of the sellers were unaware that they were disposing of their interest at far less than its scrap value. But this preoccupation with the income statement, certainly we see it today, don't we? In fact, it's not so much a preoccupation with the income statement as with an income statement way down the road. So by the 1929 crash, the once painstaking business of securities analysis had been reduced to the length of a single sentence, which Graham reprised in the following words, quote, the value of a common stock depends entirely upon what it will earn in the future, close quote. Never mind book value and fixed charge coverage, indeed, never mind price. The future, the unplumbed, unknowable, impenetrable future was all in all. And here is Graham again. The notion that desirability of a common stock was entirely independent of its price seems incredibly absurd, he continued. Well, does it seem absurd today, or does it seem rather commonplace? Anyway, Graham continues, yet the new era theory led directly to this thesis. If a public utility stock was selling at 35 times its maximum recorded earnings instead of 10 times its average earnings, which was the pre-boom standard, the conclusion to be drawn was not that the stock was now too high, but merely that the standard of value had been raised. Hence, all upper limits disappeared, not only upon the price at which a stock could sell, but even upon the price at which it would deserve to sell. Close quote. Sounds a little bit like the Wall Street Journal this morning. So Graham reminded his readers that such fantastic reasoning actually led to price earnings ratios of 50 and more. Can you believe it? 50 times earnings. Well, we do in this generation, certainly does Graham one better in this regard. Bloomberg counts 259 American companies with sales ratios of 50 and higher. So the earnings-free IPO is another contemporary novelty. It's one we have for ourselves. Negative nominal bond yields, another. And the envy vector of social media is a third singularity. New also is the practice of modern monetary theory. Graham's contemporaries had the theory, but not the practice. And a central bank explicitly working to achieve a higher rate of inflation is something that Graham saw not at all. So not new is a gale force innovation in technology and industrial organization and the creative destruction that belongs to those things. So the supposed obsolescence of asset values in general and of book value in particular is an oft-invoked reason for the long-running underperformance of value-themed investing in our time. Security analysis shows that the same theories, the same questionable theories circulated in Graham's day. Quote, so past earnings and dividends could no longer be considered, this is Graham reminiscing or recalling the line of argument in the 1920s, could no longer be considered in themselves an index of future earnings and dividends. Furthermore, these future earnings showed no tendency whatever to be controlled by the amount of the actual investment in the business, the asset values, but instead depended entirely upon a favorable industrial position and upon capable or fortunate managerial policies. In numerous cases of receivership, the current assets dwindled and the fixed assets proved almost worthless. So that was the bear story on value then. So thrilling to the future of the machine age, the Coolidge era stock market put aside concerns about the business cycle, which scientific, economic, and monetary management had anyway supposedly conquered, and the law of diminishing returns, which prosperity seemed to have repealed also. So paradoxically, as Graham observed, at the very period when increasing instability of individual companies had made the purchase of common stocks far more precarious than before, the gospel of common stocks as safe and satisfactory investments was preached to and avidly accepted by the American public. So to attempt to answer the question I posed at the start, I have a proposition for you. The lowest state of value investing is attributable first to the spirit of the times. I leave it to the social psychologists on this Zoom meeting to square mask wearing caution of daily life in America with the you only live once spirit of lockdown speculation, or with the DraftKings ads on television, make it great. So very different than you only live once is the value approach, which means, as Seth Klarman puts it, standing apart from the crowd and challenging the conventional wisdom and opposing the prevailing investment winds. So the mass tribe of Robin Hood followers seek safety and profit in large numbers, and to be sure, now are achieving it. But not even this is entirely new. Graham having remarked, as we heard, on the confounding conservative viewpoint of the partialities of the market. What's different about today's partiality is that they are government sponsored. City Hall works for the bulls. The Fed's ultra low interest rates elongate booms and cut short busts. Low discount rates flatter the value of estimated future cash flows. 0% money rates drive income-seeking investors into speculations that time and the courts will judge utterly unsuitable for them. Patience, the sine qua non of the value approach, no longer pays the dividends it did because stocks and bonds and commercial real estate and Bitcoin seem never to get cheap enough to compensate for the profits foregone by waiting. In short, time is working against the professional value investor. Marshal as he or she might the discipline of a monk or the patience of a saint, it avails him or her little when there are no assets to manage. Of course, no market is ever stripped bare of opportunity, but Graham warned about evident bargains at such treetop valuations as ours today. Quote, a severe decline in the general market will affect all stock prices adversely, and the less active issues may prove especially vulnerable to the effects of necessitous selling. Now, well did Graham know that. He was long some rather obscure items in 1929 on margin, and they did not outperform in the liquidation that followed. All of which brings me, ladies and gentlemen, to the gold mining industry, of which, to declare an interest, I am personally long. So when one says gold, some thoughts, perhaps yours, turn reflexively to the wipeout of 2011, 2015, which saw the gold price fall by 44.7%, and the XAU index of gold mining shares tumbled by 83%. Now, there is absolutely no guarantee that it can't happen again. But in my opinion, we have better things to look forward to today. Now, I'm bringing up gold because it seems to me that our monetary arrangements are at the very heart of our stock market and the very heart of the dilemma of the value-seeking investor. If there is no risk, then there need be no patience. Ergo, there will be no joy in the mudville of value. But if the central bank cannot continue to do what it is doing, if some unscripted event intervenes, inflation, credit crisis, what have you, then we'll be looking for monetary alternatives and for absolute safety in monetary terms, meaning something that can't be hacked and something that looks pretty good when the sunlight glints off of it. So the mining stocks are leveraged plays on gold. Gold is a monetary medium which competes with money and with credit, which is the promise to pay money. In particular, these days, the algos seem to think gold competes with dollar-denominated interest rates. Now, the algorithms think that gold competes with dollar-denominated nominal rates, but we value-seeking, wise men and women know that gold actually competes with dollar-denominated real interest rates. The foremost monetary fact of our time is the pulling down of macroeconomic guardrails. The Fed is explicitly trying to cheapen the currency it issues. The Biden administration is spending as no modern peacetime American administration has ever spent before. I expect that the dollar exchange rate will pay the price of these experiments. Now, gold is no easier to value than Bitcoin, but it comes with a multi-millennial proof of concept, and its very tangibility protects it against the kind of clever people who managed to hack Microsoft. The mining business is another matter, of course, with its past exasperating compulsion to dig holes in the ground, not for profit, but seemingly out of habit alone, or in sell-side phraseology, it's, quote, this is good, historically concerning past pro-cyclical behaviors. What that means, ladies and gentlemen, is these people are wretched managers, or were. but mining managements seem broadly to have made amends. And the average all-in sustainable cost of the mining industry has dropped back to around a little over $1,000 an ounce or so, even as the gold price today tops about $1,700. Now, these all-in sustaining costs are far from comprehensive. They can be gained. According to my friend John Hathaway, spot asset management costs are likely to spurt as operating rates normalize following the pandemic-induced interruptions of 2020. But the miners' margins are historically high, their balance sheets are delevered, and the mining managements are showing, at least for now, a wholesome respect for the stockholders' capital. And comparing a sample of gold miners with the component stocks of the S&P, analysts at RBC Capital Markets find that the miners win the valuation morals hand down. Thus, on the basis of enterprise value to EBITDA, it's the gold miners at about 8 times versus the blue chips at about 13 times. On the basis of free cash flow to enterprise value, it's the miners at about 4.8% versus the blue chips at about 4%. It is always good to know the truth, as Graham memorably wrote, but it may not always be wise to act upon it, particularly on Wall Street. And it must always be remembered that the truth that the analyst uncovers is, first of all, not the whole truth, and secondly, not the immutable truth. The result of his study is only a more nearly correct version of the past. His information may have lost its relevance by the time he acquires it, or in any event, by the time the marketplace is finally ready to respond to it, close quote. And there are some wise words. Yet it is immutably true as well that while you can't buy fire insurance when the sparks are flying, you can now, owing to the still lofty status of the central banks and the still unredeemed reputation of the gold miners, you can buy insurance against dollar debasement. You can buy that when the Biden administration's macroeconomic game plan is on the front page of the Wall Street Journal. Besides, the electricity gulping Bitcoin miners almost make the Newmonts and the Barracks of the world look green. Now, that is the end of my virtual speech. So, George, I thank you. Ali, I thank you.
Thank you very much. Thank you very much, Mr. Grant. We now open the floor to questions to Mr. Grant.
So the first one is to Mr. Grant. Says that it seems unlikely governments and central banks will stop suppressing interests in years for the foreseeable future. How does this end, in your opinion?
What a fine question. If I may edit it slightly, I heard the phrase foreseeable future. I would like to know, now entering my 50th year in this business, what foreseeable means. Is it like the weather forecast? On my phone, I see I put great trust in tomorrow's forecast, but very little in the 10-day outlook. And when I hear the central bankers especially talk about the foreseeable future, I have to withhold a guffaw. So one can't know the future. Therefore, one can't exactly do much but guess at the end game. I think that what is unsustainable these days is the pretension that through the manipulation of what might be deemed the key price in capitalism, the rate of interest, that by suppressing this key price, the central bankers can control events, outcomes, and bring down great showers of prosperity upon the speculating masses of the world. I doubt all that. So I think that in the unforeseeable future, there will be a great comeuppance for the central banks. I believe that the central banks are the problem, not the solution, and that what they are doing will be seen in retrospect as the most, or perhaps the most dangerous application of monetary misunderstanding to human affairs in recorded history.
Right. So the next one is from Paul Isaac. He says that Graham generally assumed there would not be transformative events for depressed companies like strategic takeovers or the bottom fishing exercises of private equity. How would Graham incorporate the greater likelihood of such events into his philosophy of events? Or would he just assume these would be random, if usually welcome events? And Paul, feel free to jump in if I didn't.
I would like clarification. That is definitely a Paul Isaac question. There are 16 clauses to it, and I would like clarity as to what the question actually means. Is there a translator for that question? I have no idea. Paul Isaac, you must help me.
Paul will need to raise his hand and then we can invite him to unmute himself.
Okay.
Paul and I are thick as thieves. Otherwise, I wouldn't presume to ask.
So,
Jim, Graham seemed to have a least common denominator. He sort of assumed that bad things would continue to happen until some change in general circumstances or a cyclical turn would eventually cause the earning power of companies to recover. So, what would Graham make of the different structure of today's market, where you've got things like people bottom fishing various types of industries that they think are depressed, and would he simply ignore that, or would he try to incorporate that into how he would value companies?
Yeah, well, I think that Graham, having been through the ringer in 1930, 31, and especially 1930, having suffered the torments of someone who was so right and almost a millionaire. That's a poignant comment, by the way, on the arc of monetary depreciation, that Graham, having been through this, would most mark what he saw and wrote about in security analysis, namely that if at a time of very extended valuations, very high valuations, you are long stocks that are cheap but obscure and illiquid, you are asking for trouble. That's how he went into the crash. He had a lot of leverage, and he was long situations that he and his partners were convinced held intrinsic value, and they persisted in holding them and did not liquidate as perhaps they ought to have liquidated in 1930 because of their belief, again, in this word intrinsic, and the intrinsic value of their holdings. So this passage that in security analysis is very, you know, the backstory, it's very moving. It's almost moving in an emotional way, because you see that Graham is writing from his own near-death personal experience, near death as we imagine him feeling at the time. So I would say that Graham would say, watch out. But how do you make a living? This is the flummoxing thing. I mean, do you stand aside at valuations that you deem unreasonable when everyone around you is thriving and you are losing AUM? I mean, how do you do that? It seems it's asking a lot of the human spirit. So I have given you a non-answer to what turns out to have been a very searching question. My regrets, Paul.
Okay, I'm going to allow Cam. Cam, ask your question. Cam Mulani.
Hey, George, how are you? And hey, Jim, how are you? I was one of George's students back in 2008, so great to be here. Just a question for you. We've seen a tremendous amount of stimulus put into the economy, and as an observer of interest rates, I mean, I would think that your bias when that stimulus was announced was that we would see meaningful inflation to date, but what we've really seen is asset price inflation. And so curious, why you think that transmission mechanism hasn't resulted in real world inflation, and what you think has to change for us to see inflation over the next few years from Biden's plans and otherwise.
First of all, I would like to remark on the precocity of the question from children who must be no older than 5. This is a remarkable question, given you're used to seeing what's on your screens as well. Two types. Anyway,
those are my two.
Oh, I see. I thought that. I might have put it together with your voice being so deep. So when the monetary impulse acted only on assets, you'll recall that the so-called monetary aggregates, the spending money that people carry around with them, did not move much, because so much of the Fed stimulus was locked up in the reserve accounts of the commercial banks at the Federal Reserve. Right? This was money on ice. What is very different today is that the monetary aggregates themselves have expanded. Now, what has not changed is the velocity of money, the turnover rate of money that is still in the dumps. But so the monetary stimulus is finding its way to Main Street. Now, whether Main Street will find in itself the motivation to spend it, to bid up goods and services prices, we don't know. But it seems to me that the alignment of the stars of unprecedented monetary so-called stimulus, of unprecedented budgetary munificence, let us call it, and the breaking down of supply chains, the shattering of the accepted norms of post-war free trade, and the pandemic-induced rethink about just-in-time inventory management. All these stars perhaps are pointing to a shift in the inflation outlook. This is, I admit to you, it's not mathematics. It's partly observation, and I suppose it's a measure of poetry and even of wishful thinking in it. I mean, I think there's probably no one listening in who wouldn't mind a little bit of market bond action, who wouldn't mind a little bit of price action to the upside at the checkout counter, just to give a jolt to our precious value stocks. But I do think that the environment for inflation has changed, and I believe that the world is in denial about it. Witness the still substantial volume of bonds trading at negative nominal yields. Witness the successful 30-year bond auction yesterday. People are more than happy to accept zero real return on securities in the face of the most extraordinary efforts of our monetary policymakers to induce inflation we have seen in peacetime.
Do you think you can see inflation without full employment coming back, or do you think?
Yes, there's no connection. There is no connection between so-called slack and inflation. Statistical connection. I challenge anyone to prove it. And there is very slight, if any, correlation between monetary aggregate growth and inflation. I challenge anyone to doubt, to disprove that. What has been the case over time, I borrow here from John Cochrane, is that fiscal breakdown has been the more reliable correlating factor with substantial inflation. We have, I submit to you, modern monetary theory in all but name. And I think that might prove to be the animating force in the next inflation.
Well, thank you very much, Jim. Appreciate your wonderful, informative presentation and interaction.
All right, thank you. It was a pleasure.